for CFA Level 1 recorded at Dubai in Berkeley, Middle East. We will discuss today study session 4, 5 and 6. Study session 4 is relevant with the microeconomic concepts, while the extension is in study section 5, and study section 6 we will discuss the macroeconomic concepts. In study session 4 we are going to discuss today elasticity, efficiency and equity, market in action, organizing production, output and cost. Going into deep details, first of all, in elasticity, we are going to discuss these broad topics. Elasticity of demand and price elasticity, income elasticity, cross elasticity we will discuss today. And we will see what are the effects of elasticity of demand and elasticity of supply on the prices, income and the other goods and substitutions. Then we will discuss what are the meanings for elastic, inelastic, and what are the behaviors of elastic and inelastic demand and supply. Then we will discuss the relationship between price elasticity of demand and total revenue. Starting our discussion, elasticity, before we go in the deep discussion of this lecture, we will discuss shortly the concept. Elasticity generally is the degree of responsiveness between two variables. Generally, if we are talking about demand elasticity, this is the degree of responsiveness between demand and price. So, the same way we can have income elasticity, which is again the degree of responsiveness between quantity demanded and the change in income. When we talk about cross elasticity, this is the degree of responsiveness or product A versus a product B. In this chapter we will discuss certain kind of terminologies. The most important is elastic and inelastic. Elastic is a word which we use for change, and inelastic is symbolized for when there is no significant change, when there is an increase or decrease in price in respect of quantity demanded. Now we will have a clear understanding of the elasticity, starting with price elasticity of demand, measure the changes in the quantity demanded in response to the change in the price. The formula for this is price elasticity of demand is equal to percentage change in quantity demanded with the percentage change in the price. Now, dealing with the CFA level 1 multiple choice question, this is a very important area which examiner is generally used to ask in the exams. Now, if any question comes like this, we will use this formula. And how to interpret in detail, the percentage change is equal to change in value divided by average value. Now this again extending, we will have ending value minus beginning value divided by the average of this month. The question might be that this demand has changed to this demand, so we will have a previous value and a new value. And the same way, the price was this and it shifted to this price. So we have a new price and we have the old price. Putting the figures in the formula, we can get the price elasticity of demand. Now, elasticity has 4 different behaviors which we can classify as high elasticity, high elastic, relatively elastic, perfectly elastic and perfectly inelastic. In terms of curves, you can see here that the elastic curve is generally a horizontal curve, while inelastic curve is like a vertical curve. And when we talk about inelastic and perfectly elastic, so perfectly elastic is same as horizontal and perfectly inelastic is a vertical curve. Now, how to deal with the multiple choice question is highly elastic demand means any demand which is subject to a big change if something happened to the price, income or the price of another goods. So a small percentage price change results in a higher percentage change in quantity demanded. So the absolute value of such elastic demand greater than 1. So in multiple choice question, if the answer is coming greater than 1, so we can assume this is highly elastic demand. Then we have relatively elastic demand. This will bring a little change in comparison with the highly elastic, and a large percentage price change results in a smaller percentage change in quantity demanded. And gasoline is an example of the relatively elastic goods, and the price elasticity is less than 1 for such kind of behaviors. Now, perfectly elastic demand, if the price increase, elasticity is the relation of, is a degree of responsiveness between two variables. And if we are talking about demand elasticity, means we are talking about degree of responsiveness between two variables. One is demand, one is price. This is called price elasticity of demand. Same way, if we are talking about income elasticity, so definition remains same, degree of responsiveness of quantity demanded in comparison with the income. So this is income elasticity. Yeah. Same way, if we are talking about cross elasticity, this is elasticity of one good in comparison with the elasticity of another good. And if we compare two goods, responsiveness means we want to see the change. If some factor, it means price is going to change the demand, income is going to change the demand. This is what the purpose to see the elasticity. And this is highly practical in stock exchange, in the interest rate calculations, because first of all, as a banker, as a financial product analyst, you should know what is the demand pattern of the stocks, bonds and the funds. If this fund is like more sensitive to the price, more sensitive to the interest rate, what could be the effect on the demand or the investment capacity of the full fund? That's why today we are going to discuss this elasticity to see the measure of degree of responsiveness between two variables. This is just to start with. In the advanced form, we will add so many things inside, but as a basic mechanism of stock exchange or the interest rates, everything starts from demand and supply. Later, when we will finish the economics, you will start feeling that everything is market driven. Even as a salesperson, you know that everything is market driven. You can make more sale if there is more demand in the market. If there is no demand in the market, you cannot sell. Either your product is the best quality product. So, as a concept, it is a relationship between price and income. As a relationship, it's a relationship between demand and price, and demand of A good versus demand of B good. Now, these two words are important to understand. One is elastic, one is inelastic. Elastic, as if you want to have a clear idea, this is the other word for change. Means anything can change the demand. So we say, okay, the demand is very elastic, means very sensitive to the respondent, to the variable. Suppose if the price it will change, demand will drastically change. The other way is inelastic, means anything happen in the market, demand is not going to change, means demand is insensitive to any factor. So this is very important to see, because in last 2 years, recession period, some people when you met them, they will say our sales is very fine, there is no problem. Some people will say we are dead almost, there is no sale.
Depends on the goods they are selling.
Yeah, it's first of all the good. The other is goods characteristics in terms of demand, elastic or inelastic. Some products is inelastic.
Water.
Yeah, like water.
Food.
This is inelastic. So as a pattern, we have to see that our product is elastic or inelastic. This concept applies again on the stock exchange. When you buy some share, you invest somewhere, you see that this company is dealing with which products. These products are in demand, is elastic or inelastic. So, linking this pattern of the demand with the profitability, you can suggest your client for a best investment solutions. That's why most of the people, what they do is telecommunication. They invest in telecommunication because everyone uses the mobiles. And then most of the people invest in the oil-based companies because the oil demand is regular. Why we study, because for passing level 1 it's easy. You need to remember few things which I will explain you, and you can secure your marks. But somehow, on the other hand, you are going to develop yourself as an analyst. Efficiency and equity, what topics we are going to discuss. One is a marginal cost. Everything has a marginal benefit and a marginal cost. What is marginal? This word we are going to use frequently. Marginal in simple word is additional. Anything you produce as an additional unit is called additional, marginal. It incurs a marginal cost, and every cost should have some benefits. And we are in the best place where MC is equal to MB, and the marginal cost is equal to marginal benefit at least. So this is how we will discuss that where we feel that the resources are efficiently located. And then we are going to discuss today consumer surplus and producer surplus. Consumer surplus is related with the consumption and producer surplus is with the production. Everyone want to have a surplus, means the best value we want to achieve from our consumption and the money that we paid. This is the difference. Discuss the relationship between consumer surplus, producer. This is how they get equilibrium. This is what we will discuss. And concept of dead weight loss. This is a term frequently will be used. This is with the imbalance of consumer surplus and the producer surplus. Sometimes you have more production capacity, but you are not doing. So it is you are under production. Sometimes you are over production. So what are the consequences in terms of dead weight loss? This is a term is related. Utilitarianism is a word from utility, means importance of something, and symmetry principle is related that everyone wants to treat in a symmetrical way. How it is, this is we will shortly discuss. And market inactions, first of all, what is market equilibrium? This is basic where the demand curves intersect the supply curve. This is a point called market equilibrium. And this is a basic definition of the market, and this is a point which we call as price. How the price mechanism is where the demand curve intersects supply curve. This is equilibrium and the price setting mechanism also. Rent ceilings. This is we will discuss that if the government is going to announce, suppose one firm is making a lot of profit and its share value is going high. But somehow it is creating on the other part, for the public, it's creating a burden. For example, the rent it should be 40,000 dirhams. It has become 100,000 dirhams as it was here 3 years before. So government has to come in because this is going to, you can say, the stops or the true investments in the economy, because people will say, this is not the right time to invest because now the things are already appreciated. So people wait for a time to invest where the prices are giving more benefits in terms of investments. Again, in the normal market, there is a demand supply, but there is a black markets. Black markets, as you know, these are the